Hello students, this is Professor Vincent Osayai. Welcome to my class. This is part 1 of chapter 2 presentation. Chapter 2, the financial statement auditing environment. In chapter 1, we talked about introduction to assurance and financial statement auditing. In chapter 2, we are going to zero in on the overview of the environment in which the auditor performs his work. Now, that being said, let's take a look at 4 different types of auditors. Number 1, we have the external auditors. These are the certified public accountants. For you to be a certified public accountant, you need to pass a very rigorous or tough examination that is administered by the American Institute of Certified Public Accountants. Now, upon the completion of the examination, each state has their requirements to become a licensed CPA so that you are able to perform audit services. Now, the most important thing here is external auditors are independent of the company that they audit. So we call them external auditors. Number 2, we have internal auditors. Internal auditors are employees of the company that they work for. They are not independent, unlike the external auditors. In other words, they are not independent of the company that they work for. These individuals or these auditors can actually be CPAs as well, but they are not CPAs from the standpoint of being independent of the company that they audit. There is another certification in the internal audit arena. We call it CIA, which stands for Certified Internal Auditor. This certificate zero in on the activities relative to internal audit. Now, the third one is government auditors. These are auditors that work for the federal, state, and local agencies. For example, the Internal Revenue Service. So these auditors go about auditing individuals and companies to ensure that we comply with the tax laws. In this case, for example, the Internal Revenue Service auditors. Now, these auditors can also have a CPA certificate as well. Then number 4, we have forensic auditors. These are auditors that zero in on fraudulent situations, okay? So that is the forensic auditors. Now, moving along, let's take a look at the types of audit, attest, and assurance services. In chapter 1, we indicated that audit services, attest services are different examples of assurance services. So let's take a look at some of the examples we have here. We have internal control audit as part of audit service, compliance audits. Those are audits that deals with whether rules and procedures are being followed, operational audits, so on and so forth. For attest services, we are talking about reporting on nature and quantity of inventory stored in the company's warehouse so that the company can obtain a loan. That would be an example of an attest service whereby you engage a CPA to take a look at the quantity of inventory that you store in a particular warehouse in order to facilitate the loan that they are trying to take from the bank. Then, of course, assurance services, as we discussed in chapter 1, deal with it's a specialized form of auditing. Is a specialized form of assurance service, like we indicated earlier. Same thing with attest services. Now, there are other non-audit services that accountants or CPAs provide. You know, tax preparation and planning services, management advisory services, compilation and review services. We are going to talk about some of these in due course. Moving along, here we have public accounting firms. We said that the public accounting firms come in different sizes and shapes. Big 4, mid-tier, regional, local. So from very local, sole practitioner, a CPA firm, to with only 1 or 2 employees, to Big Four. The Big Four, most of them have an operation basically all over the world, and they have tens of thousands of employees. Moving along, let's take a look at the audit teams. When you complete your bachelor's degree in accounting and you land a job in a public accounting firm, for example, the Big Four, the first thing is you are going to be considered as an associate staff. After 3 or 4 years, you might wind up becoming a senior in charge. Then another 4 to 5 years, you might become a partner. Then another 6, 7 years, after the case might be, you might become a partner. Of course, these different members of the audit team obviously have different responsibilities. Significant percentage of people that work for the Big Four wind up not becoming partners. So moving along, a time of challenge and change. During the economic boom of the late 1990s and the early 2000s, accounting firms aggressively sought opportunities to market a variety of high margin non-audit services to their auditors. So what are we talking about here? During this period, auditors wind up performing non-audit services to their audit clients. And some of these services were generating more revenue or more income for these CPA firms. All right. Now, by so doing, the independent auditors, the independence of some of these auditors wind up being compromised or impaired, because they were generating a lot of revenue from these same audit clients, and a lot of people actually raised a concern about this unusual relationship, but their concerns fell on a deaf ear. So guess what happened? Eventually, like I said, because of this unusual relationship between the audit firms and the auditees, some auditors wind up looking the other way in some situations, okay, or in some circumstances. And as a result, the auditors were no longer the gatekeepers they were supposed to be. So guess what happened? We wind up with the explosion of scandals in different areas, corporate giants, stock exchanges, and those scandals, those accounting scandals actually put a stain to our profession. So the general public were no longer confident about certified public accountants or auditors actually being the gatekeeper and actually watching for the public interest. So guess what happened? Then, in order for the public to have confidence in what we do, the government didn't have a choice during that period than to step in. So the government wound up stopping the accounting profession from regulating himself. And the government said, we have to do the regulation now, enough is enough. So in 2002, Congress passed the Sarbanes-Oxley Public Company Accounting Reform and Investor Protection Act. And in 2010, the Congress again passed the Dodd-Frank Reform and Consumer Protection Act. So these laws were brought into existence not only to regulate publicly traded companies by the government, but these laws were put into place a lot of safeguards or a lot of measures to actually protect the public. So we are going to talk more about government regulation of our profession in due course. So moving along, let's take a look at the society's expectations and the auditor's responsibilities. What are we talking about here? The auditor has a responsibility, as we indicated, to properly plan the audit and ultimately to obtain reasonable assurance, not absolute assurance, about whether the financial statements are free of material misstatement, whether caused by error or fraud. In other words, our duty is to plan the audit, conduct the audit effectively, and make sure that financial statements are not materially misstated, whether caused by error or fraud. So that is our primary responsibility. But the society expectations are different. So you hear a scandal and something goes wrong, the first question that the public will ask is, how come the auditors did not catch it? How come the auditors did not catch this fraud? But it is possible that a fraudulent activity would not be uncovered during the process of doing audit because of the nature of audit evidence. Remember, we talked about sampling. We don't get to test everything. Our desire is to give what? Reasonable assurance, not absolute assurance. But the general public does not know that. So that is the societal expectations and the auditor's responsibility are two different ball games. So moving along, let's take a look at the context of financial statement auditing. What are we talking about here? We said here that the primary context with which an auditor is concerned is the industry or business of his or her auditee. In other words, the context provided by the entity's business impacts the auditor and the audit, and is thus a primary component of the environment in which financial statement auditing is conducted. Now, what does that mean? In summary, what we are saying here is the industry in which the company that you are auditing operates in, or the business model or the type of business that the company is in, has a whole lot to do with how the audit is going to be performed. So the industry or the business is a critical element as to how the audit is going to be conducted. So I think this would be a good point to cut off for part one of this presentation.